Okay, good day, everybody. Hope you're having a good day today. Today we're going to move into chapter 14. Just a reminder, though, before we do that your group projects are due on Friday, March 26th, and that's the project which requires you to analyze the case provided, identify internal control weaknesses, assess the implications of those weaknesses, and then make a recommendation for improvement in internal control. So I look forward to receiving those from you. So we have basically 2 weeks of lectures left this week and next week. We'll be finishing off talking about the audit process and also talking about something other than auditing a little bit next week, something called review engagements and compilation engagements, so that you have an idea as to what those are. And then we'll wrap up with a overview of the course and discussion about the final exam. Okay, so today we're going to get into the finance and investment process, as you can see in the PowerPoint. So we'll just move ahead a couple slides. And we'll go first talking about the essentials of the finance and investment cycle. So when we talk about this cycle, you can sort of look at those words. Finance, essentially what we're talking about is raising capital in a company. So it can be long-term debt typically, or shares being issued to the company. By investment, when we raise that capital, we have to do something with it. So we may be investing that money in land, buildings, equipment. We may be going out and doing an acquisition of another company, right? So long-term investments essentially is what we're talking about here. Looking at the PowerPoint, the first bullet point says the finance and investment process contains a wide variety of accounts. Again, all related to financing investment though. Share capital, so again, common shares, preferred shares, dividends being paid on those shares, long-term debt, so raising of bonds payable, mortgages payable, for example, interest expense on the long-term debt, tax expenses relating to current income taxes and subsequently future income taxes, financial instruments and derivatives, equity method investments, so where we have typically more than 20% ownership in another company, but less than 51%, we account for our investments under the equity method of accounting. When we do that, we'll have typically gains and losses on our investments because we'll be buying and selling those companies. We may have consolidated subsidiaries, so in your MOM course, you'll be taking a course on consolidations and understanding how typically large public companies put together their financial statements. Goodwill, when we purchase another business, a large amount of what we often pay for is referred to as goodwill, or the future earning power of that business. And then intangibles, typically things like patents would be an example. Copyrights, leasehold improvements would be the types of things that we're talking about there. The second bullet point, transactions in these accounts are generally controlled by senior officials. So when we think about the other cycle that we've talked about, the revenue receivable receipt cycle, purchases of payable payments, the payroll cycle, typically those types of cycles have many, many transactions occurring in them throughout the year. And those transactions are performed by people generally at lower levels in the organization. Because of the amounts involved, typically, these transactions, as the PowerPoint just said, are normally conducted by the most senior officers in the company. So typically the CFO, the COO, the CEO are involved in these transactions. And when we talk about internal control then, as it relates to these high-level transactions, the internal control is really centered and based on these high-powered officials in each company, and to a large degree depends upon their integrity and their honesty. The final bullet point, substantive programs. Substantive programs, what we mean by that are tests of detail or analytical procedures. So those types of programs are developed by linking the risk assessment over the finance and investment process to the risk of material misstatement in financing transactions and investing transactions. So we look at the different types of transactions that might occur in terms of raising capital or spending money. What's our risk of material misstatement? And then we're going to develop a substantive test that address that risk of material misstatement. Understanding the finance and investment process. In the text, this is discussed on page 625. So if you want to follow along as we move along in the discussion here today. So in the PowerPoint, it says understanding important aspects of corporate structure requires the input of the most experienced audit team members. So because, again, of the materiality of the transactions involved in this particular cycle, and because you're dealing typically with the most senior level officers in the client company, usually it is the most senior audit team members that are dealing with these executives. So there's a person called the audit senior. That's the person who's in charge of all the staff out at the client's premises. And then typically there's someone above them, the audit manager. The audit manager has a lot of contact typically as well with the upper level executives. So again, because the risk around these transactions are relatively high, just because of their pure dollar amount, you have to have people who are involved, right, and understand auditing. You don't have the new person, right, who's just trying to learn auditing, cover off these types of procedures from a risk perspective. Disclosure requirements with respect to these transactions are very significant. A lot of financial statement disclosure required under international financial reporting standards. And it refers to the fact that recent events and frauds have highlighted the risks involving of the reporting in this particular process. So we have to keep in mind that it's the most senior executives involved in preparation of the financial statements, and there may be a fraud occurring at high levels in the company. So the most common example that we use is Enron, which was a company back in 2002, 2003 that went bankrupt in the United States. And typically there was a major fraud going on there. But there were also frauds, if we think back to the financial crisis in 2008, 2009, also frauds involved there with respect to how certain material transactions in the financial cycle for certain companies such as Lehman Brothers were being really improperly recorded for financial statement purposes. So when we consider what are the risks in this particular cycle, some of them make sense in terms of things that we've talked about before. So completeness of debt, right? Borrowing money creates a liability in a company. So from an auditor's perspective, we're always concerned about whether we have all the liability recorded. And this is none also true in this particular cycle. The second point, the valuation of financial instruments. Valuation, do we have inherent losses that have not been recorded with respect to financial instruments that the company owns? The next point, disclosure of risks relating to financial instruments and derivatives. Again, if we've entered into hedging contracts, if we've entered into derivative contracts, do we have the proper accounting in place? Are we properly recognizing the risks, in particular losses that we might incur under these types of contracts? And then the presentation and disclosure of investments that we have in other companies is very material as well under IFRS. The next bullet point, auditors are to document management's rationale and procedures for accounting estimates and audit procedures used to verify them. So we've talked about before Accounting is to a large degree more of an art than a science, and so management has to prepare many estimates. Auditors have to audit those estimates, so they have to have developed tools, strategies, procedures in order to audit numbers, which are sometimes difficult to audit. Right? So these are accounting estimates. So the types of things we'd be talking about there might be, for example, an accrued warranty payable. Right? So if a company sells a product and issues a warranty, how do we estimate the future costs of the warranties that we're going to have to pay for? That could be a significant challenge. If we think about all the automotive companies, when they sell cars, right, they issue warranties on their product, warranties, usually on engines and transmissions, and they know that some of those are going to have to be repaired. So how do they estimate what the costs of doing those repairs are? It's not necessarily an easy thing to do. The next PowerPoint, when we talk about this particular process, again, we're still on page 625 in the text. There's a chart on that page which shows you what we mean by the finance and investment process. So I encourage you to have a look at that. But the typical activities, of course, financial planning. How much money do we need in our business in order to be successful? Where are we going to spend that money in terms of land, building equipment, maybe buying out a competitor, all those types of things. How much money do we need to pay our people, pay our suppliers? How much money are we going to generate in terms of our revenue, and how fast are we going to collect that? Right? So the more revenue we generate and the faster we collect it, typically we can get by with less capital in the business. But if we have to make large investments, which are slow in being realized and slow in terms of cash coming in, that means we're going to need more money in our business and we'll have to raise more capital. And then depending upon, of course, what we're going to do with that capital, mergers, acquisitions, other types of investments, that will also involve expenditure of money, which has to be planned. Typically, when we talk about the finance and investment process, I always advise CFOs and other top management people to do a cash flow projection, typically for the next 6 months, preferably for the next 12 months, but sometimes that's not always possible because things are uncertain in today's business environment. So you should always do a cash flow projection for at least 6 months ahead, and that will tell you whether you're going to run into problems or not. And then you've at least got 6 months in order to deal with the issue. If you don't look ahead and project where you're going to be, that's often how you get into trouble in any business. This PowerPoint on corporate governance is on page 626 in the text. Again, you don't have to be aware of the Canadian rules in particular. Here it talks about CPA Canada's guidance for directors on corporate governance. But essentially what this is talking about, how do we have control at the board of director level? We've talked about internal control a lot in this course, but internal control as it relates to different accounting cycles, right? Again, revenue receivable receipts, purchases payable payments, payroll, detailed level controls, general control considerations such as segregation of duties, and then application controls, right? Other detailed type of controls that we have. For example, in the purchase cycle, matching of documents such as matching the supplier invoice with the receiving report and the original purchase order. That matching process, right, is a key control, but that's not done by the board of directors, is it? That's done by lower level people. So what types of things should the board of directors be doing in order to have good control over a business? Excuse me. So this PowerPoint addresses some of the things that you would expect to be occurring at the highest levels in the company. The first one, approving the mission, vision, and strategy, right? Why are we here, right? What is it that we want to become? That's the vision. how are we going to get to where we want to become, right? That's going to be our mission, right? So, and then how are we going to complete our mission? We need to have a strategy, right, in order to complete our mission. So mission, vision, and strategy all tie in together. Um, approving and monitoring of ethical values, right? Very important in business today, because businesses are monitored, of course, by many interest groups in our economy. And the minute typically something goes wrong, it's often reported in the press. So we want to have high ethical standards, and as well to motivate the people that work in our business, so that they believe that they're going to be addressed and treated fairly. Monitoring management control, right? So management, we know, is responsible for producing the financial statements. They're also responsible for the internal control system that produces those financial statements. Well, how do we know as the board that management's doing their job, right? We have to be monitoring management to ensure that they are exerting proper control over the business themselves. Also, evaluating senior management. If you go back into the payroll cycle, you'll see that one of the controls to improve performance by people is to give them regular evaluations. So in most businesses, that's done at least once a year, sometimes twice a year, sometimes on an informal basis, sometimes on a formal basis. But in order to spur people on, right, to encourage them in their development, we have to have evaluations done, right? So that just tells us, are we doing a good job? Do we have to improve? Overseeing of external communications. Of course, in a company interacting with its environment in which it operates, there should be high level control over what is said, right, to the business community outside of the corporation. And then how good of a job is the board of directors itself doing with respect to these types of responsibilities? And it needs to assess its own effectiveness. If it's not doing these things, it's not very effective. If it is exerting these controls, it is more effective. But again, even typically on board of directors, it's good to have a change in the board of directors from time to time. Some boards do a better job at this. Typically, boards where people are changing, perhaps every 6 to 10 years, you need a fair bit of time on the board just to get to know the company and to make sure the vision, mission, and strategy is proper and be around while that's being implemented. But typically, companies also need new ideas, and so they need to have people who will contribute and have a positive effect on driving the company. So normally it is important to have replacement of board members from time to time. Sometimes board members don't like that, though, because of course they're getting paid, right, while they're sitting on the board, and many of these board positions are quite lucrative, so they're hesitant to give up these board seats. Excuse me. Okay. One thing I've already mentioned today is discuss a bit more on this PowerPoint number 10, talking about raising of long-term debt and issuing shares, right? Share capital in an organization. The PowerPoint says transaction and debt and shareholder equity capital are typically few in number but large in monetary amount. Right? So material from a dollar perspective, but it doesn't happen very often, right? How often does a company go to the public, right, to raise capital? Maybe once in their lifetime, maybe twice in their lifetime. Some companies never, if they're private companies. And then how many times do companies take on significant portions of long-term debt? Not that often normally in the lifetime of a business. So we have transactions which are relatively few, but large in dollar amount. So large in dollar amount means there's risk, right, of error just because of the size of the dollars. But then also few in number means it's difficult to have a system in place which monitors activities in this area when those activities don't occur frequently, right? They're very infrequent. So to have a control system in place for activities which are infrequent, I'll suggest there's a high probability that that system will break down because it's not working, right, on a day-to-day basis, essentially, because there are no transactions occurring. Okay. The other aspect of this we've already mentioned, of course, the transactions are, because they are few in number and because they are large in dollar amount, typically managed by the most senior officers in the company. Okay, so let's talk a bit about the application of control, okay, over the finance and investment cycle. Again, keep in mind the type of control we're going to be talking about here are essentially controls at the highest level, right? Because if transactions are being conducted by the senior officers, that's where we would expect to see the control in place, right? Okay, so the first one, again, we've seen in the other cycles, authorization. So in order to have control at a high level and ensure transactions are properly authorized, what should we have? Just what I mentioned a minute ago, a cash flow forecast, right? Where is the money coming from? So it might be coming from revenue transactions. It might be coming from issuing debt. It might be coming from issuing shares. And then how are we spending it, right? Our capital budget. So are we buying land, buildings, equipment, buying other companies, etc. Right? So that plan, once put together, of course, should be approved by the board of directors. So a financial plan approved by the board of directors gives authorization, right, to raising capital in whatever form that might take. Now, one of the things we have to be concerned about is there are some types of financial transactions which are what we call off-balance sheet transactions. So typically, derivatives would be a form of off-balance sheet financing, sorry. And to some degree, leases, so equipment may be to some degree an off-balance sheet finance activity, much less so today than it used to be because of changes in IFRS rules. But historically, there was an issue with respect to leases, and the fact that many leases were not recorded in the balance sheet. So that was one of the largest ways that management could manipulate their financial statements, was by having a lot of leases for equipment as opposed to purchasing equipment. Because when you purchase equipment, debt is shown on the balance sheet, but when you lease equipment, in the past, typically it was not. Now, again, those rules have changed fairly recently, so that most leases today are in fact recorded on the balance sheet. Okay, custody. When we think about custody, and we keep in mind the types of transactions that we're talking about, borrowing capital, right, or issuing shares of a company. So in large companies, we have to keep track of who owns the shares, right? So if we have hundreds of thousands or millions of shares outstanding, who actually owns those shares? So large companies will hire a trust company or what sometimes a transfer agent to keep track of the shares, right? Because the shares are changing hands, right, every day as they trade in the stock market. So, for example, if we're going to pay a dividend, who owns the shares? Right? We have to have access to that information. So, again, large companies typically hire a trust company or a transfer agent to track their shares. Small companies, of course, they don't typically have share transactions. A private company business, typically a family business, they start up their business. They don't buy and sell their own shares. They own their shares for many, many years. So in that case, the shareholder records are often maintained by the lawyer who's acting for the company. Okay, that's the most common practice there. But certainly in a public company, you'll have a trust company or transfer agent acting as what they call the registrar for the company. And the registrar is just the organization that's keeping track of who owns the shares, right? So to have proper control over who owns the shares so that we know who to pay dividends to, for example, or if we want to buy back shares, who owns the shares, again, hire a trust company or transfer agent to do that work for you. When money is loaned to a business, you're going to have an actual legal document in place. So if you issue a bond payable, for example, there's something called a bond indenture put together. The bond indenture is just a contract between the borrower and the lender. It's a very substantial legal document, often will be 2 or 3 inches thick, right? A lot of paperwork, because a bond typically is money borrowed for a long period of time, 20 years, 30 years. And because it's borrowed for such a long period of time, there's usually quite a few covenants. Okay, covenants are essentially rules that the company has agreed to live by. So, for example, the company might say our debt to equity ratio will never be greater than 4 to 1. If it is greater than 4 to 1, then the lender, because of perceived risk, right, might have the opportunity to appoint someone to the board of directors, as an example. That may happen. Okay. So in terms of these actual bond indentures, though, who actually has the physical documents that have been signed, right? So normally there's one original, and that's kept by the company that loaned the money, right, to the borrower. But the borrower will also have a copy, right, of the original document for their records. So custody over a loan document, being the original document, remains with the lender, right? Just so that if they ever have to enforce, right, some of the covenants under the bond indenture, then they have the original document and they can go to court to take what action they deem necessary in the circumstances. Record keeping. We have to have proper record keeping in order to maintain control over the capital that's been issued in the company. So again, we've already talked about bonds payable. So control over actual legal agreements typically will be with the lender of the funds. But again, normally the CFO, they will have copies, right, of the actual bond indenture in their possession, so that they can ensure that the bond payable is actually being accounted for properly, right? So they can reference that legal document as they may need to. On the other hand, with respect to recording of liabilities, this PowerPoint refers to various calculated liabilities and credits. So these are amounts which we recognize are debts of the company, but which are subject to some degree of estimation, right, and assumption. So we have to ensure that there's proper documentation in place, right, for management to be able to control properly the amount of debts which are being recorded. So what are some of the areas which are difficult in terms of the calculation of liabilities? Well, they mentioned a few at the bottom of this PowerPoint. Future income taxes, right? How much are we actually going to have to pay in the future? So we know that what will the future tax rates be, for example, right? Pension accounting, right? How much money do we have to set aside going forward, right, in the future years in order to satisfy all the pension liabilities that we have created? Well, to some degree, that is determined by how much will we earn on the money that's been invested, right? So things like this can create difficulty in measuring of the pension liability. Lease obligations. The issue around lease obligations typically is the contracts are very complex often, so hard to understand. And then the whole idea of which leases must be capitalized and which ones do not have to be capitalized. So again, that requires the CFO typically to have detailed knowledge of the leases and ensure that proper analysis is done to determine which ones should be capitalized and which ones don't have to be. So we need a process in place, right, to properly estimate our lease obligations. We need a process in place to properly estimate our pension liability. We need a process in place, right, to measure our future income taxes. So again, all of these areas, because they are uncertain, right, and just calculations, we have to have processes in place in order to properly record the proper amounts. We'll talk more about that in a few minutes. But proper record keeping control is very important. That's discussed on page 627 in the text. Another control that we've seen in other accounting cycles, periodic reconciliation. And so if we think about back to the revenue cycle and the purchase cycle, Bank reconciliation, right, is one of the periodic reconciliations that should be done to ensure proper control exists over the bank account that's recorded in the financial statements of the company. Well, the same thing here. Periodic reconciliation is important, but reconciliation of what? The share register, it says, should be reconciled on a regular basis to ensure all shares issued are recorded. So how many shares have we actually recorded in our financial statements? We want to make sure that's the same number as that transfer agent or trust company tells us have been issued. So reconciliation between what the transfer agent is telling us, who's keeping track of all the shares, and then how many shares we actually show as being issued in the financial statements. Those two numbers have to reconcile to each other. And so typically in large companies, right, they'll have a certain number of shares outstanding at the beginning of the year, let's say 10 million. Then they issue more shares, right, let's say 2 million. Then they buy back some shares, right, let's say 4 million. And then you get your balance at the end of the year. Well, this is the reconciliation that needs to go on, starting with the beginning of the year number and getting to the end of the year number. Of course, that should be done on a regular basis. So we need to have the control in place to ensure someone, right, is doing that reconciliation. Again, someone who's independent, right, or properly segregated from conducting investment and finance transactions. Long-term debt can actually be confirmed with outsiders, right? Because we have borrowed money. So a letter can be sent to the company we borrowed the money from and just ask them, how much do we owe you? Right? So we can compare that once they write back to us and say, you owe us $50 million, reconcile that number, right, to our financial statements in terms of what we say that we actually owe. If there's a difference, we have to account for it. If they're the same, no problem. Right? But reconciliation to that external source of information is another control. Right? It helps to ensure the accuracy of the number in our financial statements. So all of those controls, right, in the other cycles that we talked about apply in this cycle, but at a much higher level. Because again, keep in mind, it's the senior officers of the company that are dealing with these transactions. Excuse me for a minute, just gonna take a drink of coffee. Okay. Now, continuing on, we've talked mostly about the financing side. Let's talk a little bit more about the investment side. So the investment side of this cycle starts to be discussed on page 628. So once we raise this capital, right, we've talked about the controls that should exist over the financing side. How about the controls that should exist over the investment side? Okay, what we've done with the money. So in the PowerPoint, it says a company can have many investments or only a few. You can have a wide variety of them. And because when you raise this capital, you have to decide what are we actually going to invest in. Part of what we may invest in says maybe intangible assets. Intangibles could be in the form of purchased assets, or it says accounting allocations. So for example, leasehold improvements are an intangible asset, right? We can physically touch them, but we don't actually own them, right? The most common type of intangible asset is what we call goodwill, right? Would be the most common type. Goodwill typically is classified in its own category in the financial statements, but it still has the characteristics of being intangible because it's something that we spend money on. It's something we know which is of value, but we can't physically touch it, right? And so that's goodwill would occur with respect to typically purchase of a business, right, as we mentioned earlier. And then in the form of accounting allocations, that could refer to costs which have been capitalized as assets. So for example, on occasion, research and development costs are capitalized, right, in the balance sheet. And so again, that's money we've spent, we can't physically touch, right, the benefit of those expenditures, but yet we know they may exist. So now think about the investment side of the equation, right? As I mentioned, we just walked through the financing side, talking about the controls that should exist there. How about controls over the investments we've made with the capital that we've raised? So the next few PowerPoints are going to talk about this. And again, this starts on page 629 in the text. All investments should be approved by the board of directors, or some companies actually have a separate investment committee, which is a subcommittee of the board of directors, right? So high level control. So board approval maintains control over our investments because it maintains control over how our money is going to be spent. Custody, when you think about custody of these investments, including intangibles, of course, is going to depend on the nature of the asset that we're talking about. So if we invest in a share, or if we invest in bonds, the physical shares themselves or the bonds that we've invested in, of course, could be held in safekeeping somewhere, maybe at a bank in a safety deposit box, or very often the shares and bonds are held by the broker, right, on our behalf. So we're going to maintain custody through one of those different means over the asset. As mentioned in the PowerPoint, it says for other assets, custody may take the form of management responsibility. So intangibles, again, they kept patents, trademarks, copyrights, are usually kept in company files. Again, typically these senior members of management, right, is going to have access to this information. So a patent itself, the actual patent document, normally is going to be kept, right, in a locked drawer, locked vault somewhere, similar to trademarks, etc. Okay, so these are just legal documents, right? So they have to be safeguarded, put into a safe place so that they don't get lost. Intangibles, such as goodwill, are in custody of accountants who calculate them. So custody, it's not physical custody, is it? But it's control or custody over the balance that's appearing in the financial statements. And is it correct or not? Has there been an impairment in goodwill? Right? Someone has to be responsible for the accounting over the balance to ensure that it is appropriate. And so that person who's in control over ensuring the balance is appropriate has custody, right, of that balance because they have management control over that balance. Record keeping, of course, is very important with respect to these investments as well. Procedures for the purchases of shares and bonds involve authorization by the board, right, or possibly senior management. If it's a material transaction, usually a board approval will be required. Again, record keeping for investments and intangibles can be complicated. This is discussed on page 629. And the reason they say it may be complicated, so for example, we may purchase a bond and there may be a discount or a premium on the bond, right, which has to be amortized under the effective interest rate method under IFRS. So that may be, right, a difficult process. It's a complex process to ensure that the accounting is done properly. When we acquire shares, we may have to assess, right, what's our percentage ownership in the company? How should we be accounting for the shares? Should that be at fair market value? Should that be under the equity method of accounting? Of course, if we control another company, maybe we have to look at consolidation. Okay, so all of these different accounting implications, right, make it complex in terms of the actual record keeping, okay, that has to take place. But again, someone has to have control over the record keeping, right? So we're going to, who is in charge of ensuring that the proper balances are maintained for the shares that we own, for the bonds that we own, right? So again, we'll be looking for segregation of duties there to have someone in charge of ensuring the record keeping is accurate. Periodic reconciliation, again, is discussed on page 629. So we can think with respect to shares and bonds that we own, we have them physically, right? It's a physical item that we can hold in our hands. So we can actually, as is suggested here, count the securities, right? So if we have 10 bonds, we should have 10 pieces of paper saying, here are my bonds, and reconciling what we physically count to what's recorded in the actual financial statements of the company, of course. And so I know when I used to, my earlier days, when I did audits of brokerages, we would actually count, right, the securities, right? That was a major activity at the end of the year. Count the securities in the possession of the broker and agree that to the accounting records, right? So for a very large company, that takes a large amount of time, of course. But by ensuring a reconciliation process is in place, it's a way to determine if there have been any errors have been made in the accounting records. And so normally we're going to want, again, someone independent of the actual acquisition process, right, to be involved in doing the reconciliation in order to catch errors if they have occurred. So from an audit perspective, we can see these controls, right, are going to be at a high level because typically top management has control over these activities. But again, we have to think about what's the nature of the activities. And as is referred again to in this PowerPoint, says finance and investment transactions are usually individually material, right? Each one is material. Well, what are auditors concerned about? Auditors want to ensure the financial statements are presented fairly in all material aspects. So if each transaction is material, what do auditors have to do? They have to audit each transaction, right? So because each one is material, each one presents a risk of material misstatement. So auditors have to normally ensure that they look at each and every one of these transactions because they are few in number and they are all material. So because they're few in number though, and material, what do the auditors do? Reliance on control does not normally reduce the extent of the required audit work on finance and investment cycles. So even if we relied on internal control, we will probably want to do substantive tests, being tests of detail normally, on the balances, right? Because they're individually material, right? We can't even have one error in these transactions without affecting the financial statements. So if we're going to do substantive procedures anyhow to verify a balance, right, whether it's an investment balance or a financial capital balance, why rely on internal control? That would be a waste of time, right? So normally, in most audits, the finance and investment cycle does not rely on internal control at all because the transactions are few and each one normally is material. The other complicating factor is control over these transactions where we have a fair bit of risk is in the hands of a few people, right? Top management. So remember, top management's goal is basically to keep their job, right? Get more money. And so they may, create errors in the accounting records to further their own objectives. So we have to be careful at the top of the organization. Lack of control, right, can also lead to doing more substantive procedures. If you have a poor segregation of duties at the top, of an organization, that means you have to do even more substantive duties. Why? Because those senior officers of the company could be involved in individually material transactions, right? So this is an area which is virtually audited 100%, okay? And virtually no reliance on internal control, although auditors do look for weaknesses in control in this area. Because the transactions could be material, auditors need to warn their clients, right, if control is inadequate. So we're looking for weaknesses in control, in particular in this area. So as I've just been discussing, When we look at general controls here in PowerPoint 20, it states responsibilities lay in the hands of senior management officials, right, the people at the top. It's difficult to have strict segregation of functional responsibilities when management officials are involved. Why is it difficult to have strict segregation of responsibilities? Because there's only a small number of people, right? You only have one CEO, one CFO, so it's tough to have a strong segregation of duties in order to rely on internal control. So again, because you don't have that segregation of duties, because the transactions are few in number, and because each one normally is individually material, right, you don't rely on internal control. Now they state a compensating control might involve two or more persons in each kind of important functional responsibility. So they give us a couple examples. Now, a compensating control, we haven't seen that word, I think, much at all in the text. The controls that auditors rely upon, they're called the key controls. Right? The controls, management has many, many controls in their accounting systems, but the auditors can't rely on all of them. They select the best ones. The best ones are called the key controls. Now, in a certain area where control is maybe poor, for example, in this cycle, right, there's a poor segregation of duties because we have a small number of people in top management, maybe we have a compensating control, a control that achieves the same objective, even though it's a different control. So here, the next PowerPoint says, if the board of directors authorize the purchase of securities or creation of a partnership, the CFO or the CEO could carry out the transactions, have custody of certificates, and oversee the bookkeeping. Okay, so here they're saying the authorization is not in the hands of the CEO and CFO, it's in the hands of the board of directors, which of course is a group of people, right? So rather than the CEO and the CFO making investment decisions, it's the board, right? So the compensating control is that the board has taken control over making the investments, not the CEO and the CFO. They're just fulfilling what the board wants to do. So the next point says use compensating controls, periodic reports to the board, reconciliation by internal auditors. So what that's referring to is that if top management is going to be involved in authorizing purchases of investments rather than the board, then a compensating control could be a periodic, normally a monthly reporting to the board. Here's the transactions that we did during the month. Here's what we bought, here's what we sold, right? Submitting that to the board for approval. Reconciliation by internal auditors, of course, reconciling, again, they're talking about the physical control, physical number of shares, physical bonds to the accounting records, right? So if we can reconcile, right, what we say we own on an ongoing basis, and that's done by an independent party, internal auditors, for example, they're separate from the CEO and the CFO, that would be a good compensating control because the internal auditors are doing what? They're checking up on management, right, to ensure that they're doing the proper job. Okay, we'll go on from there. Control over accounting estimates. So this is discussed on page 631 in the text. We've mentioned that one of the most difficult areas of accounting is the area of accounting estimates. And in fact, there are many accounting estimates, right? If we think about accounts receivable, the allowance for doubtful accounts is an accounting estimate. If we think about inventory, market value, right? Net realizable value of inventory is an estimate. And the rule for inventory says lower of cost and net realizable value. When we think about capital assets, the residual value, estimated useful lives of buildings, all the equipment we own, these are all estimates. On the liability side, of course, we accrue liabilities, right? At the end of the month, that's an estimate in terms of what we owe For example, for property taxes, other types of expenditures have to be accrued. Okay. In future income taxes, we already mentioned, involve accounting estimates because we're making an estimate today of an amount to be paid many, many years in the future. And we have defined methodologies in which we do these things. So who's responsible for preparing the estimates? Well, management is, right? And so we want to ensure that management, though, just can't pick numbers as they want to. Right? It shouldn't be a process whereby management decides in their own discretion what the number is going to be. Right? We need to have a system in place, a control structure to ensure that the accounting estimates are sound and materially correct. So that's what the next couple of PowerPoints are talking about here. Use of estimates in accounting is common, as I just mentioned. It's in many, many account balances. Test of control amounts to inquiry as to controls in place for estimation. So what they're, poor wording here, but what they're trying to say is you auditors have to ask what are the controls the management has in place to ensure that accounting estimates are properly prepared. Excuse me. Right? How do we know accounting estimates are properly prepared? Because management themselves, CEO, CFO, they're not going to sit down and do them. They're going to review them. So what controls do they have in place to ensure that they're done properly? From an outside auditor's perspective, the way we test them, recalculation, right? Just checking the math basically. And a key one is comparison of the auditor's estimate to management's estimate. So management might come up with a number, but the auditors could also come up with their own number. And then the auditors would say, well, why is my number so much different than your number, right? And especially in areas of accounting estimates. So for example, right, I think I've used this before, an audit I used to work on involved a book publisher. And let's say the book publisher's year end was December 31st. So when they would ship books, typically in November and December, they would record them as sales. But the problem was that when they shipped the books out, there were return privileges, right, given to the companies that bought the books. They could return the books. So the problem was at December 31st, you would have to estimate how many books are going to be returned. So in order to do that, we developed a methodology to estimate ourselves as the auditor how many books were going to be returned. And this was based on a historical model that we put together, right, using the client's data and looking at past results to say, here's a procedure that can be used to test substantively by recalculation, basically, coming up with their own estimate, what management's estimate should be. And then when management's estimate was different than ours, talking to management and say, well, here's our assumptions, there's your assumptions. Why do we have different assumptions, right? And so we would have to talk that out, and one of us, right, the management or the auditors, would have to change their assumption based on the discussion, again, assuming it was reasonable. Sometimes management had to change, sometimes we changed, being the auditor, because we misunderstood something. So what types of controls can management put in place to ensure that any numbers dealing with accounting estimates are appropriate? Again, this is discussed on page 631 in the text. So the types of controls could include management communication, right? The voice from the top just saying, hey, it is important, right, that we have proper estimates in our accounting records. In coming up with estimates, it should be based on relevant data, enough data, and data which is reliable. Right? So where's our data coming from that we're using to prepare estimates? Is it relevant, sufficient, and reliable? We should have qualified people, right, preparing the estimates. So if we're going to have someone do a calculation of future income taxes, it should be someone who's done that calculation before, right, an experienced person, rather than perhaps just someone learning about it for the first time. Someone learning about it for the first time is more prone to make mistakes. Once the estimates are prepared, they should be properly reviewed, right, by a senior person. Typically, it says appropriate authority. Normally, it would be the CFO, right, has to review the estimates, and you might also require a second approval, right, perhaps by the audit committee, perhaps by the CEO. The next one is a very good one in terms of proper control. Is there a comparison of the estimates that you made previously to assess the reliability? So last year, here was our estimate. How did that actually work out? Right. So in my audit scenario, when we publish books, here's the estimate we had last year. How many books actually came back? Right? Were we close? If we were close, great. If we weren't close, why not? Right? So we can learn from our past mistakes. Right? That's what this is talking about. We did the best we could in terms of estimating the number, but as it turns out, it was not correct. And so we want to maybe improve our model, right, that we use to come up with estimates. And then also the next one, consideration by management, again, normally CEO, CFO, on whether the estimates are consistent with operational plans, right? So if we look at sales, our operational plans are to continue to ramp up sales. So if our sales rose 20% this year, what happened to our accrued warranty liability? Did it go up 20%? It probably should have, right? So we can look for internal strengths in terms of these accruals we're making being consistent with our actual operations. Again, if sales go up 20%, we would expect our warranty liability to go up 20%. Did it? If it did, it probably looks reasonable. If it didn't, why not? Right? What happened that caused the estimate, the accrued liability, to be lower than we thought? So again, comparing our estimates, right, to ensure they're consistent with what's actually happening in our business operations can be another key way to verify that our estimates are reasonable. Okay, when we look at debt, okay, how can we manage our internal control risk as it relates to debt? Again, here in the PowerPoint, they talk about notes and loans payable, but it could be any form of long-term debt. So the first point, it says some companies have numerous debt financing transactions, warranting a more detailed approach to testing of controls. But that would have to be a very, very large company that has many, many, many borrowings. That's going to be extremely rare, right? It does happen, yes, typically, for example, a mining company, right? So some natural resources may have multiple debt transactions. But again, because each one normally can be material, and typically there's few transactions in terms of new debt actually issued each year, normally you would take a substantive approach and not rely on internal control. So when it says here a more detailed approach to controls, it's not talking about actually testing and relying on internal control. They're just saying look a little more closely at internal controls. Now, they do mention an internal control questionnaire in Exhibit 14-2. Okay, that's on page 633 in the text. So that just gives you, again, a walkthrough of application controls that might exist in the various forms of audit assertions that we've seen previously. So they mentioned a couple points at the bottom. It says the questions on that control questionnaire are records kept by someone who cannot sign notes or checks, right? So in accounting for debt, we wouldn't want a company to be able to issue debt and then have that same person sign checks, right, to pay the debt. Otherwise, they could borrow money personally, record it as a company debt, and then have the company make the payments on what is really their personal debt. That would be a poor segregation of duties. The next point says, our bank due notices compare with records of unpaid liabilities. So if we have unpaid liabilities, bank due, the bank sending us a notice saying, hey, you haven't paid something. Well, do we have that recorded as a liability or not? Right? So relying on outside documents to ensure that our accruals and amounts are appropriate. Again, yes, that internal control questionnaire can be helpful in terms of looking at the controls in place, but not from a perspective of relying on internal control, but more from a perspective of advising management where their internal control is weak, right? Because again, auditors have to approach their audit and make management aware of any internal control weaknesses they become aware of during the course of their audit. So typically, as a client service, even though we as auditors are not relying on control in this cycle, we still review control with the idea that we want to at least warn management if they have poor segregation of duties, for example, in this cycle, we want to talk to them about that and show them the risk, right, that could come about and be materialized in terms of losses should, right, something inappropriately be done by management. So again, it's usually a client service reason as opposed to an audit reliance reason for looking at control in this area. Now, going back to the Enron example and other examples that we had, AIG, there was a big company called insurance company, still exists, called AIG back in 2008 or so. They had many, many derivatives, but they had not been properly accounted for. Okay, the company had major losses, billions of dollars that they were going to lose, and that those losses were not reflected in the financial statements. So, of course, coming out of that scenario, auditors, top management said we have to have better controls over derivatives if we are going to have derivatives as part of our financing structure. So what types of controls could management have in place over derivatives? Okay, and so there's some very easy ones. When you look at these controls, you sort of wonder, why wasn't management doing this, right? Inside of AIG, for example, who knows, right? But it's such common sense, it raises the issue. Probably it's just because derivatives were fairly new still back at that time. Many companies didn't really finance through derivatives, but AIG happened to be one that went overboard and lost a lot of money, in a sense, had to be bailed out by the US government because their bankruptcy would have had ripple effects, right, throughout the world economy. So what types of controls do we want to have in place over derivatives? The first one, monitoring by independent control staff. Right? Someone should be overviewing the accounting for derivatives, someone who is separate from actually entering into the derivative contract. Right? So that's a segregation of duties issue that we've seen previously. The next point, derivatives personnel to obtain senior management approval before exceeding limits. So that was one of the problems in the AIG case. There were no limits, right? So the derivative trader was able to do whatever he wanted to. Well, of course, proper control would say you're limited to X dollars, and if you want to go over that, you need senior management approval. So that's what is being suggested here. Senior management to address limit excesses, right? So if someone invests in excess, right, of what they should have invested, well, then management should be looking into that, maybe taking action against that person. There should be accurate transmittal of derivative positions. So what that's talking about is there should be a reporting mechanism to the board of directors so we can see what's happening. Are we making money or losing money on our derivatives? So regular reports, right? Regular reports help to control derivatives because someone else becomes aware of what's going on. Performance of reconciliations, again, just ensuring that our derivative contracts that we've actually entered into have been properly reported in the financial statements. The next point, traders and management to define constraints, monitor activities, and justify excesses. So just suggesting that derivatives and people involved in those types of contracts have to have constraints in terms of what they can invest in, how much they can invest in a particular instrument, etc. And whatever those constraints are, you have to have a monitoring process in place, perhaps the internal auditors, right? And then justify excesses. If you want to exceed the predetermined limits, why? Right? Should be a control to generate these types of questions. The next point, senior management or independent advisor, for example, internal audit department, should do regular review of controls, right? The controls that we're mentioning here, and what are the results? Are they working or not? Review of limits and test risk tolerance. So if we're saying the traders dealing in derivatives are limited to X dollars, right? That should be reviewed on an ongoing basis in light of our risk tolerance. Maybe our risk tolerance decreases, right? Which means we should be taking less exposure in derivatives. So these are all common sense controls, which unfortunately didn't exist back in the AIG days, but of course have been developed when things go bad, and we learn and we develop new controls. Okay, so what are we looking for with respect to assessing whether these controls that we put in place are working or not? So this is referred to as the objectives of internal control. On the first point, we want to make sure that transactions entered into with respect to derivatives are executed in accordance with company policies. We want to make sure that information is complete and accurate. That could be in reports, right? Going to the board of directors. Is it complete? Is it accurate? Misstatements and processing information are prevented or detected in a timely manner. So as we do process the derivatives in the business, right, is there information which came to light, perhaps that we weren't aware of before? Misstatements, right? So those misstatements have to be properly reported to an appropriate level of management or the board. The activities should be monitored, right? The activities of the derivatives trader should be monitored by management. Changes in fair value should be accounted for. Well, that's part of what was not going on in AIG. Right? So if we're having gains and losses, they should be reported, right, on a monthly basis, reflected in the financial statements. And then control systems for hedges should assure that the criteria are met. The criteria they're talking about is the criteria for hedging. So can we account for hedging transactions in our organization or not? There are certain criteria you have to meet in order to use hedge accounting. Most companies do not use hedge accounting because that's complex, but if you wanted to, you have to ensure you're meeting the criteria. That's what's being suggested here. Okay, so after having looked at control, right, in both the capital and the investment portions of the cycle, we make a summary assessment of internal control risk, as we have done in each of the accounting cycles we've talked about so far. As is stated here, auditors will often audit 100% of investment and finance cycles. Why? Reasons are given. Few transactions make it efficient to give complete coverage. Right? Because in most companies, there's probably only 1, 2, 3 transactions that occur during the whole year. So it's much more efficient just to audit those transactions 100% because they are few in number and because they are individually material, right? You can reduce the risk of improper reporting by auditing each transaction 100%. And also, of course, why would you do a complete study of internal control, right, which takes a lot of time and testing of controls when it's more efficient just to do a small number of substantive procedures, right? So testing of controls in this area would be inefficient, so why do that? In addition, again, they mentioned here, internal control deficiencies are important to the audit. Why? Because it gives you hints around where the risk of material errors could occur, and you want to do some substantive procedures to ensure that those risks have not been materialized, right? The losses have not been incurred that have not been reported yet. The next bullet point says complicated financial instruments call for procedures to detect errors, irregularities, and frauds. So again, complicated financial instruments, for example, derivatives, right? We have to ensure that procedures are in place for us to test, right, the derivatives to ensure that any losses which are appropriate have been accounted for properly. But that means, right, you have to have the knowledge to be able to do that type of audit work. Right? So you're going to have to understand derivatives, the economics behind it, and how the accounting should go for it in order to determine whether there has been a fraud or not, right, in that particular area. So very complex, right? Has to be done by the more senior members of the audit team where procedures are more complex. Okay, sorry everybody had to, so my computer froze up, so I had to go out and reboot. So let me just spend a couple more seconds on this PowerPoint just to make sure that I wasn't cut off previously when my computer froze. Uh, so when we review internal control over this area of a capital finance and investment, auditors normally do not rely on internal control. The reason is there's few transactions, right? So it's more efficient to do substantive audit procedures on a few transactions than spending all the time to review internal control, right? And to test internal control only to find out that the internal control in this area typically is weak because of poor segregation of duties. So you would spend a lot of time reviewing internal control when in fact you could not rely on it. So it would be very inefficient, right, to do that. And so we don't. So we audit these transactions substantively, 100%. So it means looking at actual tests of detail, looking at accounting documents, doing recalculations on the data. However, we have noted that one of the reasons we also look at internal control. It is a client service, but if control deficiencies exist right in this area, we want to ensure that we properly compensate with substantive procedures that address the areas of risk. So identifying internal control deficiencies are still important because it will direct the substantive audit procedures that we should be doing. Okay. And as well, it's a client service, right, to the client to be able to tell them where their internal control weaknesses exist in this particular cycle. Okay, so let's move into talking about some of the substantive audit procedures that auditors do in the finance and investment cycle. And so in the text, this starts on page 637. So with respect to owner's equity or shareholder equity in a financial statement, what are the assertions that are made by management? The number of shares shown as issued are in fact issued. Right? So if the company says we have 20 million common shares issued and outstanding, do those numbers actually exist, right? Are they actually issued and outstanding? Their assertion is that no other shares have been issued and are not recorded. So we're saying all the shares recorded are complete. Right? We've recorded everything that's been issued, and there have not been more issued that are not recorded. So the number of shares is actually complete. The accounting done for options, warrants, and any other stock plans, and in particular, the disclosures for options and warrants which are outstanding are adequate under the IFRS rule. So that's the disclosure principle. The valuation of shares issued for non-cash consideration is appropriate. So sometimes we've, of course, acquired another company. We don't do it with cash, we do it with shares. So have those shares been properly evaluated and presented in the financial statements? And then we also assert that all the equity transactions reflected in the area of common shares or preferred shares have been authorized by the board of directors. So in order to, these are management's assertions, right, in the area of shareholder equity. So what types of audit procedures do auditors do to verify those assertions in the shareholder equity section? So inspection of documents. Owner's equity transactions are well documented. So normally you have board of director approval for the issuance of shares. So if the company said we issued 5 million shares during the year, well, were there 5 million shares authorized to be issued? We should be able to see that in the board of directors minutes. So the board of directors minutes plays a very important role in this cycle. Right? If all these transactions are material, they should have been approved by the board of directors. So that's very typically where you go to, right, to look for approval and authorization of these various transactions. Confirmation, we can send a letter, right, to the transfer agent or trust company, which is accounting for all their shares. Right? So we can send a letter normally at the end of the year asking the transfer agent, please advise on the number of shares outstanding at the end of the year. Please advise on any shares issued during the year. Please advise on any shares repurchased during the year. So all those details can be obtained from the transfer or trust company agent that the company is using to keep track of their outstanding shares. And normally that letter is done during the course of the audit. Now, if we think about long-term debt, right? So moving from shareholder equity into long-term debt, what are the assertions being made by management with respect to long-term debt? Again, these are summarized on page 640 in the text. Well, management states all liabilities are recorded, right? The completeness assertion. All liabilities are properly classified as between current liabilities and long-term liabilities. Any new liabilities have been properly authorized by the board of directors. The terms, conditions, and restrictions of debt issued during the year are disclosed properly in accordance with IFRS. the maturities and lease obligations and disclosure of those is adequate and in accordance with IFRS. And then if there are contingencies, right? So for most companies, there are no contingencies that have to be recorded, but very often there will be contingencies, contingent liabilities that have to be disclosed. And so if they have to be recorded, of course, we have to ensure they're properly accrued, or we have to be able to assess that the contingent liability is properly disclosed in accordance with IFRS. So the assertions made by management is that all contingent liabilities have been properly either accrued or disclosed in the notes of the financial statements. So how do we know as auditors whether those statements are true or not? Well, confirmation, right? So sending a letter, right, to the lender of funds, asking them, right, not telling them, asking them how much debt is outstanding at the end of the year. How many payments were made on debt during the year, split between principal and interest? What security, if any, do you hold for the debt? All those details can be sent in an audit confirmation by the auditors to the lenders, right? And usually, even when a debt is paid off during the year, you still send a confirmation to the lender that one final year. Why? To ensure that the debt has been paid off and that there are no lingering issues with respect to the outstanding debt, right? That the lender agrees it's been fully repaid. Sometimes I've seen problems arise in this area where there may be disagreements with respect to how interest is to be calculated, right? Because we know each payment, typically on a bond, will involve some portion of interest and principal. Well, if there's a disagreement as to how the interest should be calculated, that means the split, right, on each payment between principal and interest perhaps is slightly different between the borrower and the lender. And of course, this can cause problems. Maybe the borrower thinks all the debt's been repaid, and the lender says, no, it hasn't. So this is another reason why, of course, you want to send a confirmation, right, to the lenders, especially where, and perhaps even still, where the debt has been paid off. Off-balance sheet financing, again, this is discussed on page 641. It's difficult to be able to identify, right, commitments and contingencies, but where they do exist, there has to be no disclosure in the financial statements. And very often with respect to off-balance sheet financing, so again, this could be typically through leases, but it might involve other types of financing. Analytical procedures are very, very useful in this area. And one of the most common things you'll see is the recording of interest expense, right? So if you have interest expense recorded in a financial statement, what should you also have? You should have debt, right? Well, how can you have interest expense if you don't have debt? So if you're recording interest expense, there should have been a debt recorded. I mean, I have seen errors made by clients where they record interest payments each month, but they just forget, right, to record the actual initial amount of the debt, the amount of the money that they borrowed. They forgot to debit asset and credit debt, right? Just recording the monthly interest payments. So normally auditors, right, will compare the interest expense this year to the interest expense last year, right, to ensure that it appears reasonable. If there is interest being paid, right, on a debt, well, that has not been recorded, of course, that's a hint, right, the client has done something wrong, right? The second bullet point, it says lesser expense the audit calculations show might indicate misclassification, failure to accrue interest, right? So we calculate the interest and it should be $2 million. The client only has 1.5 million. Well, the client forgot, right, to accrue interest at the end of the accounting period. Right? So recalculation, right, of balances does make a lot of sense in this area. So it ensures interest expenses properly reported, of course, but it also ensures that we've picked up all the liabilities that exist. Right? Again, the theory that if we have interest, we need to have a corresponding debt to be recorded. Various types of calculated balances that we've talked about before. Again, this is discussed on page 643 in the text. Future income taxes, right, is a very common one. You may have deferred revenue, right, revenue that's being recognized over several years. Well, you have to be able to calculate that, right? Client has done it. You're going to recalculate it, right? Understand the rationale for it. Make sure you're happy with it, right? So we can simply do a lot of recalculation. Is a substantive test, right, on an account balance to ensure that it is correct. Okay, on the investment, so that's more on the liability side again, the types of substantive procedures that we do. How about on the investment side, right? The asset side of the balance sheet, what do we do? It says companies can have a wide variety of investments and intangibles. Management's assertion on these assets depends on the nature of the investment or the intangible. So for example, it says investment securities are on hand, are held in safekeeping by a trustee. That's a control over existence. Management says the securities exist because they're held, right, and controlled by an independent trustee. The next bullet point says investment cost does not exceed market value. Right? Of course, if it did exceed market value, it would have to be written down, but their assertion is market value is higher than cost. Their management asserts that significant influence investments have been accounted for by the equity method as required by IFRS. Management asserts that purchased goodwill is properly valued, i.e. there has been no impairment. Management asserts that certain intangible costs that have been capitalized, right, were acquired in exchange transactions, okay, which would provide a way to value the shares. Okay? So, for example, if we acquired goodwill, right, when we acquired another company and we issued shares, you have to say that the shares were issued by our company to do that acquisition, and part of what we accounted for as acquisition costs is goodwill. Right? Well, shares have to be properly valued in order to come up with the proper goodwill figure. Okay, and then any amortization on any intangibles has been properly accounted for. So these are your assertions made by management in the area of investment intangibles. So how do auditors verify these assertions made by management? Confirmation, right? Well, if securities are held by an outside trustee, let's send a letter and say, our client's records show you have 10,000 common shares of Tesla. Do you? Right? So we confirm the existence, very common audit procedure. We inquire. So we can inquire, as company counsel can be inquired about issues relating to intangibles. So we may have patents, right, that we own, but there may be ongoing legal issues as to with respect to the enforceability of those patents. Right? So again, we can talk to inside counsel around valuation of the intangibles. Maybe there's losses that had to be recognized. Very common again, income from intangibles. Okay, if there are royalty agreements in place, right, we can simply recalculate the amount of royalty, right, based on the contracts. So again, I used to do this when that book publisher I was mentioning, they would have royalties payable, right, to their authors. So we would pull out the contracts and say, what are the rates of royalties that are supposed to be paid? And are they being paid or not? Right, so that was a pretty straight process, but recalculation, right, of the client's liability. Inspection, if a company says it owns patents, copyrights, trademarks, right, pull out the files, actually inspect them to make sure that they exist. If it was just acquired in a year, right, because it's a material transaction, probably trace to the actual legal documents where the patent was acquired or copyright purchased, and look at the payment, right, therefore. Document the vouching. What they're talking about is the fact that anytime you look at underlying accounting documents, you have to put into your audit file that you've done the work. Right? It's only by verifying, right, the actual balances and documenting it that we can, after the fact, prove that the work has been done. So again, a few of the points they have here. Investments can be vouched through broker statements, right? So if you're using a broker, obviously to buy and sell securities, you can actually look at those statements to prove gains and losses. Market valuations, it says, may be required in some cases. So yes, where we have short-term securities held for trading, we have to be able to get outside market source information to verify management's assertion that the market value exceeds cost. Research and development expenditures, it mentions vouching may be extensive. Vouching, we're looking at accounting documents, right? Probably checks paid for payroll, checks paid for materials, other types of expenditures of a development nature, which we are capitalizing. That could be a lot of work. Right? The last point says auditors can use quoted market values, dividend reports, and financial statements of investments. So what they're talking about here is short-term and long-term securities. So short-term securities, you have to get quoted market values. Right? So there are different services that you can look at that provide market values. Of course, you can research it on the internet today, nice and easy, easier than it used to be years ago. Right? Pre-internet days, right? That's when I started my auditing. The internet, right, was just starting to get developed at that point. You couldn't sit down and Google things like the way you can today, of course. So a lot of this information you had to get outside third-party market reports, right, to verify market values. Also, of course, if you have long-term investments, which are being accounted for by the equity method or consolidation, you want to be able to look at financial statements, right, for those companies to determine, is there an impairment required or not? Right? If a company is losing a lot of money, maybe there's actually been an impairment that needs to be reflected in your client's financial statements. Equity method of accounting, I've already mentioned, where of course one company has significant influence over another. It's common that, and always done, assuming materiality, that the auditor will obtain the audited financial statements for the company in which your client has invested. Right? And so where you have acquired that financial statement, you have to be able to check depreciation and amortization calculations, okay, are appropriate reflected in your own client's financial statements. Inquire if there's been any intercompany transactions between your client and the company in which it's invested, okay? And also talk about, of course, management's intentions. Does management intend to continue to hold that security for the long term or not? Equity investments normally are long-term investments, and they are recorded in the case of significant influence under the equity method. But if you intend on selling that investment, it's potentially the case that a loss might have to be recorded, right? If the market value of that investment has reduced, and you're now going to report this investment on a market value basis instead of an equity basis because you're going to dispose of it, well, again, that may create a situation where there's a loss. Right? Gains are not reported until we sell the investment, but losses are recognized, right, once they're recognized. So obtaining financial statements where we have equity and method investments is extremely important to ensure our own accounting is correct. Can be difficult sometimes, right, to obtain those equity method and underlying financial statements, because maybe the auditor for the investment that we have to look at is not the same auditor, right? So we might be KPMG, for example, while the financial statement we need is being one prepared by Deloitte, right? So management will have to get a copy of that audit report from Deloitte on the investment which they hold. Well, when's that audit being done? Right? Maybe the subsidiary, right, or the equity method investment has a different year end, right, than the auditor. So there could be some challenges here in terms of, it sounds easy, just get the financial statement, make sure there's not an impairment. It's not always that straightforward. Hopefully it is, but not always. Okay, the remaining items in this particular chapter just talk mostly about some examples that they have at the back of the text. What I'll do next day, I'm just going to stop at this point. The last few PowerPoints, the last 5 PowerPoints or so in this chapter, talk about fraud. So I'll start here next day before we move into chapter 15. Okay, just looking at my time, I think going for about an hour and 3/4 or so. So I'll stop here for today. Next day I'll pick it up at PowerPoint 40. I'll cover off the last 5 or 6 PowerPoints here in chapter 14, and then we'll move ahead into chapter 15. Okay, thanks everybody. Have a good day. Again, any questions or problems, please shoot me an email. Or if need be, I've done a couple of Teams meetings along the way too. Okay, thanks, and we will see you on Wednesday. Take care.